Hello everybody and welcome back. Well, I'm sure many of you are scratching your head saying what just happened and how is this market going up after a 75 basis point hike? We'll be trying to explain that based on our data and analysis that we've used over the last couple of days. And we'll also be discussing whether this market can actually go on to clean up some of these gaps or inefficiencies that were left behind during the big sell-off. The Federal Reserve didn't really have anything good to say about the US economy right now, other than they were going to raise rates again. The question is, now, how much? Is it 50 basis points or is it going to be another 75 basis points? What's in store could surprise you over the next coming weeks as we may rally and then potentially dump, or it might be just all about to get really bad. Stay tuned as we talk about the structural setups across crypto, stocks, and of course commodities. See you very soon. Well, welcome back everybody to the daily show here where we talk about stocks, cryptos, and commodities every single day. If you like any of those markets, remember to subscribe and give us a smashed like button if you find value in today's video. Let's talk about 75 basis point hike. Of course, that's not really a surprise. 99% of economists and everyone expected it after the core inflation numbers were brought out just last week. The next thing becomes how many times are they going to raise in the future? So the committee decided to raise the target for the federal funds rate to 1.5 to 1.75% and anticipates that ongoing increases in the target range will be appropriate. Basically, they all agree it's out of control and they're going to have to raise another 50 to even 75 basis points in the next month. The market, however, didn't mind this. They went up, and you might be thinking, how's this possible? It's because of what happened in the price flow and the order flow before this announcement. Remember, we just dropped 10-11% plus in the Nasdaq and the SPY. This means that the market has the ability to go up first because nothing changed from the expectation that was already being put into price. It meant risk on was basically occurring, and we saw risk on across all of the technology stocks. And when we look at the broad market, it also meant that Nasdaq was performing the best. So Nasdaq had a very strong session. Here's the announcement. As per usual with news announcements, it goes one way, bang, straight back down, grabs liquidity, creates fear, everyone doesn't know what just happens, and then boom, goes the dynamite to the next direction. This is exactly what happened to us a few times so far this year, where we've seen a spring or at least a very nice pickup by the algorithms, by the composite man, by whatever you want to call Wall Street in this day and age. 2.5% in terms of Nasdaq by the end of the day, and Dow was up only 1. So what that really points towards is risk was on and all of the risky sectors were being purchased. Clearly, it shows here clean energy, solar, consumer discretionary, technology, communications. They were the best performers. And what doesn't like necessarily what they heard? Funnily enough, energy. You might think, well, energy does well during interest rate hikes. Yes, but it doesn't do well when interest rates, that is the yields, start to fall. And when we take a look at that later on today's video, you'll see what I'm talking about. Let's now talk about quantitative easing or tapering and during those kinds of times. So we've obviously got tightening times, we've got easing times, and then we've got neither of those times. Now, it's been a while since we've had neither, but look at this, the tightening times here for the SPY. When tightening happens, what do we tend to get? Chop City. What does that mean? Very much a day trader market. Swing traders beware. We've been mentioning this quite a lot. Usually you have high VIX, and when the VIX is above 20, swing traders tend to get really hurt. So just remember that when fear is high, and especially during these tightening periods, there is a lot of chop in markets. That's what we've seen in the past, and I think we have to expect it in the future. It doesn't necessarily mean the market's going to keep crashing and going down further and further and further, but there could be a lot of ups and downs throughout the rest of 2022. It's why it's the year of the trader and not necessarily the year of the investor at this point. Quantitative tightening, again, if we look at the bond market, tends to be a little bit different. So it goes down initially and then it actually went back up. So again, a little bit of chop, possibly a little bit of a switch or turnaround in bonds. We'll have to watch it. And then we've got the last one, which is of course crude oil. So this is what everyone's talking about. Energy is the best sector in the market at the start of 2022 and really 2021 as well. And again, during a tightening period, we start to get chop in energy or potentially even a decline going through that period. So be careful in a market like this. You can see the start and where we are right now, which is a bit of volatility starting to appear in oil. We also talk about optimism. Everyone's fearful. The media has been in overdrive. Of course, YouTubers out there as well. We all have, big, hard-hitting statements about crash and all of those types of things. And this has led to optimism just in general across the board, regardless of who you are, has been incredibly low. But check out some of these dates. Now, not all of these dates coincide with lows in markets, but it's interesting to see some of these points here, such as Jan 19, March 2020, and of course where we are right now. And then what actually ended up happening. When everyone is fearful, often that is a time to be greedy. And if you see the right signs, potentially it can make sense for some people in their longer term positions or longer term situation in their portfolios. Obviously, that's more of an investor style concept than a trader style concept though. Let's talk about the data that got us to this point. So of course, we turned to being more bullish over the last 2 days. The main reason why is because of this stat. When the Nasdaq falls over 10%, the next 3 days tend to be overall bullish. In fact, 73% of the time they remain bullish, and that's what we end up getting. We also know that when we have incredible falls, such as 4 days of 9% plus across those 4 days on the S&P 500, it has generally coincided with interesting points. Not every time has it been the low. We can see over here in 2008, it certainly wasn't. And in 2020, it still fell off a cliff and kept falling. But considering the market where it is, the time of year, all of those types of things, there could be a real case to be said here that there's a bit of a turnaround, at least at this stage, for the day trader, for the scalper, and possibly even the multi-week kind of trader. We also know that watching yields is important, and we won't go through this chart, but just remember, if ever you see over 50% of yield curve inversion, that is the 2-year, 10-year, 3-year, 10-year, all of these types of combos inverting, be careful, and that's something to worry about in the future should it occur. So let's get into the charts together. Let's talk about this market. Patience, react, don't predict. That's the big story at the moment in terms of markets. We've seen some big reactions in the last 24 hours of the market. We'll talk about that soon for the SPY, Nasdaq, and of course, Russell 2000. But let's get in here to the fear. So fear actually dropped. After the event, going into the event, fear was at a peak. We hit the 35, and then it dropped back down, going all the way to around 29.6. Now, is the VIX still high? Yes, absolutely, it's really high. So it tells us that there's still a ton of volatility in these markets, and you have to expect the unexpected. But where things get a little bit more interesting is after the announcement, the 2-year yield dropped through the floor. It actually changed trend on this time frame. It went to a new peak, and then it came down and it breached below. So we probably expect the yield to come up, possibly hit like a 3.3, and maybe turn around again. If this is the topping of the yield for now, that coincides well with the market being able to go bullish. Remember, the S&P is very, very, very susceptible to this. To ever prove a concept like that, load up the SPX. And what you'll notice is if you're looking at the S&P 500, as the yield goes up, often it does affect the S&P 500. And if you look at this on something like a daily, you'll notice how that coincides over time. When the yield stabilizes, sometimes you'll have the ability for the market to go up. When the yield obviously turns around and goes completely up or it goes down, you have the chance of the market going in the direction. So that's very important. Let's move over to the US dollar. It's still holding the defended zone for now. We've had this box here for a couple of days. We've talked about how there's probably orders sitting behind here on the DXY, the US dollar. And if it falls through this zone, then we're seeing the first time frame change of trend for the US dollar. This also could be considered now, some people will be looking at it as a Wyckoff with some potential UTs and UTADs setting up. And again, it all kind of revolves around a breach that could occur around this 104 kind of 60 area. We get underneath, we see a pullback, and we probably will see shorters start to come into the US dollar. And that will again bode well for the markets, because what it will mean is money is coming out of cash, potentially going into bonds and of course growth such as S&P 500, Nasdaq, etc. US oil took a little bit of a dive. We've talked about the change that we saw just a few days ago over here on the 1 hour. It made the new low. It then rallied a bit and then fell through. I'm very cautious here on oil at these prices. Obviously, it got back up to the 124. I've been no lover of oil really for probably about a month now. I know it's been doing well, but it is one of those points where the spread of the idea, or most people are talking about it, I don't tend to like things when everyone's talking about them, and I usually see that as beginning of the end. And of course, with the price action that we've got here at this stage, still a little bit weak. Why I say it could be a little bit risky is when we're talking about higher highs and higher lows. Remember, one of the higher lows here has just been taken out. So that kind of points towards, at least smaller time frame, a little bit of a short bias here on things like US oil. And if you bring up natural gas, you'll notice that just got absolutely hit in the last few days. It actually fell about 18% here. Be careful with natural gas, everyone. If you ever trade it, they call it the widowmaker. I call it the heart attack. And the reason why is because it moves incredibly quickly. Look back in history, you'll see incredible whipsaws of upwards of 20 to 40% spikes within only a few days. XLY XLP, an indicator we use here a lot to tell us whether risk is on or off in the market. We've used it very effectively recently to kind of predict the Nasdaq should be outperforming the SPY on recoveries. And so far that is really coming true. So basically what we have here is we have the standardized double bottom that most people know. The market came down and made a new low. However, this ratio of risk on consumer discretionary versus risk off consumer staples, it didn't really change. It actually held up, showing us that there's some rotation from the street into growth. And at this point, as long as the market keeps rallying, you would expect the Nasdaq to outperform the SPY for now. And I think a lot of that has to do with metals and energy taking a little bit of a cooler for this time period. Tesla had a good day, not too bad. Long leg doji, technically it has closed above that long leg doji. Possibility for it to continue rallying is now here. We obviously know where we've got a heavy level of supply or resistance, which is up here around the $780 mark. Good clean of the gap. Let's take a look at it on the 1 hour chart just so you guys can have a look at it a little bit more closely. Realistically, you're trading Tesla just because you like Tesla at the moment. It's not because it's the best trade. The better trades are to look at the SP 500, the Dow, the Russell, those types of things, because the market is going to move very quickly like this. And the Tesla technicals aren't going to hold up as well during a time of fear like we've currently got. So we've breached through, we've cleaned up this gap. At this stage, it looks like it's relatively bullish. And I could see Tesla quite easily getting back into this zone, as when we look at the market, that is something that's there. And Tesla has been relatively strong with its pickups during this risk-on style periods. What hasn't been as strong is Apple. Apple creates another long leg doji. So we have now a smaller doji here. We've got the bigger long leg doji on the daily, and we come up to the previous support levels, which have acted as resistance, and we clean the first gap. We still have a big gap up here, which could be filled by Apple. And I think Apple is just looking a little bit weaker on the charts than some, but still it will move with the Nasdaq, with of course the SP 500 as they come up. So big levels here would be 151, a huge level for breakout. That would really prove that all of this was just a false break, maximum pain to the downside, and things are looking much better for potentially the next couple of months, actually, if you break through something such as this on something like Apple. So it may be worthwhile having an alert up there in the future if you want to come back to a stock like this. Let's move over to DAX. So DAX held the defended zone. This was the area that we looked at the last 24 hours. A very big area for it. It still hasn't filled some of the gaps. It's sold off aggressively. It's now formed a little bit of a base. So let's have a look at the 1 hour time frame here on the DAX. What you'll notice is that a significant closure would be above here. So a significant portion is above here. We have supply. We have resistance that's been formed several times. We obviously have the maximum pain, and we've created some form of structural base on the DAX. This will become more clear when we look at the S&P 500 soon, but a very, very nice structural base, obviously gaps to be filled if possible on something like the DAX, and it does look better, but it's going to be dictated to by more the American market than anything else. If we move over here to IWM, another long leg doji here from the small caps, not that strong in the small cap pickup. Breach through 175 should clear up the gaps. Day traders will be looking at that and breaking it down to smaller time frames to look for this kind of movement here from the 175 to the gap range. That could certainly happen over the next 24 hours. And at this stage, it looks like it's kind of consolidating and holding demand as best as possible around that serious level. And we do want to see the Russell 2000 increase in the next 24 hours of trade with the market if this rally is to be believed. Small caps should really come with or even lead sometimes the main markets. The Nasdaq had a nice breakout. So let's take a look at this on the 1 hour. We can see those two big gaps. But again, the Nasdaq actually led here from the rest. And I think we'll use the futures market to really show you this. So let's take a look at the futures market. You can see it's ramping at this stage. But what happened was it went through this area here. And it all happened during, of course, the announcement. This is the way news works. We breached this 11.5 area. We knew there was supply here. There's orders sitting behind this level. They breached those levels. The resistance is taken out. And a lot of you will think of this as a Wyckoff schematic. Now, if you think about it as Wyckoff schematic, you've kind of got your SC down here. You've got ARs, etc. Obviously, this one here could be considered max pain, or what I consider max pain. Some of you will call it something else. Doesn't really matter. That is that the market has swept the orders here, creating fear. The news media has gone into overdrive psycho, telling everybody, oh, fear, 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 fear. And then the market has come up. It's held this area really nice and it's moved through. And then during the news, it comes down to grab liquidity. And it's come down to this area here to grab liquidity and swing through. Now, this reminds me very much of the previous time this happened, where if we scroll over here to this period, this is what happens. The first directional move is often the false move. So just like over here, like we discussed previously, and we've talked about a lot on this channel, make sure to subscribe if you want more of this type of information. We hit a level, we swing it, and then of course, we end up with a huge rally past that point. Now, did that rally make sense to everybody? No. Of course, a lot of the time trying to make sense in a market like this is very, very difficult. But if you think about the structure, it's looking towards, you would think, trying to fill some of the things that's left behind. And as we know with the SP500, it's kind of similar. We breached through this level we've talked about so much. Previous support, resistance, supply here, 38.10, 38.20. We then pull back and then we move to fill or try to fill potentially this first gap. Where does that take us to? Well, it takes us to around 39.01. The next one, if it was going to happen, takes us to a 4,020. So these are two massive levels that are potentially going to be filled. And notice how the real market here, what it does is there was a gap on the open. One of the guys in our private community, I'll shout out, Shogun, Ulrich, he said, you guys got to be careful here today of the gap in terms of what happened with the open. And that, of course, got filled during the day and then rallied back through. So there was a lot of opportunity in the last 24 hours. And certainly these levels are very, very important to look at. Let's now look at the structure of how the US 500 set up. So we know this was a critical level. We know that the market came back down to potentially spring off these lows, and it's now gotten above this zone on the real market as well, above that 38.20. This kind of points towards a bit of a change of trend on the small time frames. Now, it doesn't mean that your daily's not down or your weekly's not down and overall bears could come back at any point, absolutely. But it does mean that the structure set up here on the smaller time frames has improved. And a lot of people, again, will look at this as Wyckoff, see that as max pain, see that as a spring, see that as selling climax, and understand that this is a potential schematic here for turnaround. Picking bottoms is very difficult, so you've got to have tight stop losses and you've got to understand what you're looking for. But this is the right type of setup at the right type of time for the types of markets that we're in right now, which is mostly fear-driven and everybody being trapped into certain concept or certain thought process while the market goes and does something else. So for anyone that was recognizing this and seeing it, I'll give you a clap. Well done, guys. It's not easy out there. This market is tough. The composite man, or at least Wall Street, they're trying to kick our ass every day. So it's us versus them. That's how it is. But how we want to do it is actually join them, yeah? We want to fight all of us, actually. We want to fight the rest of the community, technically, or the rest of us all get into it. That's the point. We want to follow what the algorithm, what the order flow is doing. When we talk about options, this might not be updated just yet, but maximum pain is something we talk about a lot. If all options were to expire perfectly and Wall Street was to make the maximum amount of money from selling options to whoever they were selling them to, themselves, and also, of course, retail traders, they would set the position to close this week at 415. Now, that would be pretty stupid and probably a bit crazy to talk about at this stage, but that's technically where it is, and it's starting to pull down. So what that really means is that I expect this number to come down by Friday. And at the same time, you don't target that number. What you target is if you see a turnaround and max pain's way higher, it might give you a little bit of confidence to say, maybe not 415, but there could be a nice bullish move here and it might give you a little bit of confidence. That's how you use it. or use this type of thing in a sideways coiling market for butterfly style concepts, etc., if you know what options are and how to use them. Let's talk about Bitcoin. Bitcoin has 2 decent days on it now. We've got the long leg doji over here, and we've also got the bullish hammer. It went down just on almost 20,000. Everyone was fearful, and now we've seemingly rallied. Bitcoin is not rallying the same way that the markets are doing it. If you think about the structural setup right now, we're not even through this area here. And it is coming with the Nasdaq, but at the same time, there's a lot at stake here in the crypto market. We could be in crypto winter. It's going to be a tough trade out there. If you're buying it, I think you're buying it more with gut feel and obviously just saying, I'm going to turn it into some kind of investment. I don't know what you're doing with it, but I'm not seeing the structural setup that you like to have here. And it may rally, but it's going to rally mostly because of risk on in the markets, if that is what we end up getting here. And at this stage, it looks more positive than negative for markets in the next couple of days. We'll have to find out whether that's true. If you haven't already followed us over on Twitter, definitely consider doing so. We post a bunch of stuff there. @FXEvolution is our handle. And of course, click the links in the description down below and join our community, whether it be the public community, get involved with the community, or the free 7-day trial to our private community. We'd love to see you in there. And we've got thousands and thousands of members, which is awesome to have. Core retail sales number was obviously an abysmal number, and the Fed have obviously said that everything's out of control. But at the same time, when we basically scroll through, we've got monetary policy coming on Thursday with the official bank rate from also the UK coming out. We'll see what they do. We've got some policies coming out from central banks, and we've got Bank of Japan press conference. That's a big one, of course. The Japanese yen coming under a ton of fire right now in terms of how people are perceiving it. People are even questioning Japan's sovereignty at this stage. And then we've got Fed Chair, the Papa Powell, coming out and talking at 8:45 a.m. New York time on Friday, June 17th. So there's a lot of news still to come. These markets, although they're not the US, some of these will be moving the market. Don't worry about that. And the decisions across the board will have big impact. So be nimble, be fast, and of course, guys, please practice risk management. That's the biggest thing right now. Remember to subscribe, smash that like button, and we'll see you in the next one. Bye for now.